Hello options traders, welcome everyone and happy Friday. I just wanted to follow up and finish up the week here with another technical indicator video, and this time to talk about Williams percent R. Earlier in the week we talked about the stochastic oscillator, and so now we're going to follow it with Williams percent R. So why am I choosing this indicator to follow stochastics? Well, you're going to find out quite interestingly that they are the same indicator, they're just viewed from different points on the chart. And I think that's important because I've actually heard traders that say they use Williams percent R to confirm stochastics. And it's really useless because it is the same indicator. We're just looking at it from a different perspective. So let's take a closer look at Williams percent R, how it's calculated, and how to interpret it. Well, Williams percent R, as the name implies, was invented by a person named Williams, and it was developed by Larry Williams in the late 70s. So it came out about 20 years later than the stochastic oscillator, which again, interestingly, even though they are virtually the same exact formula. It is a momentum indicator that shows the current closing price relative to a range of prices. You've seen that exact bullet on the stochastic oscillator. Why? Again, because they're the same. In fact, Williams percent R is the inverse of the stochastic oscillator. The default range is a 14-period time frame. So once again, the reason we say 14 period is it just depends on the time frame. 14 minute, 14 day, 14 week, it doesn't matter. It's just 14 something. That will be the default. Once again, you are free to change it, but that will be the default in the platform. So let's take a look at the formula, and I like to look at formulas when applicable because it helps you to understand where the numbers are coming from, but it's also going to show you why it's virtually the same thing as the stochastic oscillator. So Williams percent R is usually designated by percent R. That's what the little indicator will show in your platform. And the formula is we're going to take the high minus the close and divide it by the high minus the low. And then we're going to multiply that by negative 100. So to make sense of this and to see why it's virtually the same thing as the stochastic oscillator, let's pull up the formula from that video and compare the two. Let's start here with the denominator and notice that they are identical. We're taking the high minus the low. Now again, high minus the low means the highest price that was printed during that 14-period time frame. I'm just going to assume it's a 14-day time frame for this video. So in the past 14 days, what was the highest price? What was the lowest price during those last 14 days? And we're just going to subtract those two numbers out. That gives us the denominator. It's exactly the same thing. But the numerator portion over here is different. If we look at the stochastic oscillator here, the percent K line, it takes the close minus the low. So the current closing price, or the current price if we're looking at a live graph, subtracting off the lowest point. However, Williams percent R takes the highest price minus the close. And so what we're really doing with the stochastic oscillator is we're saying how far away is the current price from that low period. With Williams percent R, we're saying how far below are we from the high. So it's just two different ways of looking at the same information. Now, unlike the stochastic oscillator, we do not have a percent D line or a 3-day moving average of the percent K line. So Williams percent R doesn't do that. There's no moving average overlaid with it. It's just simply the percent R line. You're just going to see one line on the graph and that's it. Let's go back to the stochastic oscillator formula here. If you recall from that video, I said let's assume that the stock price during the last 14 days, that the lowest price was 100, and that during that same time frame, that 110 was the highest. And right now the stock is trading for 107. So if you look at the formula, again, let's start with the denominator, the high minus the low. So we're looking at 110 minus 100. That's a 10-point range. So that would be the base here, or the denominator in the formula. Then it says take the close minus the low. Closing price is 107 minus the low is 7. Notice that we're taking the close minus the low because that's going to make it a positive number. Closing price is above the low. So we said that if we have 7 divided by 10, that equals 0.70. We multiply by 100, and that's going to give us a stochastic oscillator of 70%. So keep this formula in mind and you'll see how it's exactly the same thing viewed from a different angle when we look at Williams percent R. With Williams percent R, once again we have the same denominator. Take the high price minus the low price during that time frame, so the base is exactly the same. But notice what the numerator tells you to do. It says take the high minus the close. So we're now going to take 110 minus 107, and that gives us 3. 3 divided by 10 would be 0.30. We multiply it by 100, that's going to give me 30, but notice we actually multiply it by negative 100, and that's to make this number negative. So why do we do that? Because Williams percent R is saying how far off are we from the high? We are 30% off the high. Stochastic Oscillator said how far are we from the bottom? We are 70% up above, or plus 70 from the bottom. So saying that today's current price is 70% from the low is exactly the same thing as saying that it's 30% from the high. So it should be obvious that Williams percent R is also what's called a bounded indicator. There's only so low it can go and so high it can go, exactly like the stochastic oscillator. For Williams percent R, the indicator must fall somewhere between 0 and minus 100. If it's at 0, it's saying that you're at the high. You are 0% below the highest print. If it's minus 100, it's saying you're 100% below that high or you're at the low. So again, Williams percent R will be somewhere between 0 and minus 100. It's just on the inverted scale from the stochastic oscillator. And just like the stochastic oscillator, ranges of 20 and 80, of course for Williams percent R, it will be minus 20 and minus 80, are usually used to denote the oversold and overbought levels. Just keep in mind it's going to be reversed. Now what I mean by that is to remember that for Williams percent R, minus 50 is going to be the halfway point. So if you are getting a reading of minus 50, it means that the current stock price, or the current close, if the market's closed, is exactly halfway between the high and the low of those past 14 days. But if you're somewhere in this range, you're actually getting closer to the high. Now sometimes new traders think that because you're moving up, that this number has to get bigger. It's going to be minus 60, minus 70, minus 80. You have to remember when you're dealing with negative numbers, that's not bigger, that's smaller, because it's a percent reduction. So as you move in this direction going towards the high, you're going to see things like minus 40, minus 30, and so on. And finally, if you got all the way up to 0, it just says that the current price is 0% below the high. In other words, you're at the high. Conversely, if you're on this side of minus 50, you're more towards the low. So that means you're going to be like minus 60, minus 70, and so on. The very lowest you could be is minus 100, which is saying that you are 100% away from the high. So just keep that in mind, that the number, what we call the absolute number, meaning ignoring the minus sign, if that number is big, 100, it really means you're on the low end of the scale. If that number is small, getting towards 0, you're near the high. Okay, let's take a look at Williams percent R in action. Let's go back to the platform. I'm going to stick with Apple because that's the same ticker that I used for the stochastic oscillator. We're going to select from our studies menu, and right down here is Williams percent R. There's our default, 14 periods. Overbought range, minus 20. This is again towards the high. Oversold range, minus 80. These are the defaults, and we can make them anything that we want. But for the most part, I would usually stick with the defaults. Why? Remember, the main reason that technical indicators work is because it's mass mentality. Everybody else is looking at them, and everybody will be responding to these same general points. Doesn't matter that you want to put minus 42 and minus 17 and saying that those are your turning points. If nobody else is looking at them, they're meaningless. These numbers are what most people are looking at, and so I would stick with these. So once we click there, down below is Williams percent R. I'm going to change the scale here. In fact, let me shrink up the chart price a bit. Let's start with the scale. Check over here to the right. Notice that the high end of the scale is minus 20 and the low is minus 80. Again, think of it as the percent reduction. That's not what percent R stands for, but sometimes it can help you to remember what it means. So if you're 20% off the high, you're towards the top. If you're 80% from the high, you're towards the low, and that's what this scale is showing you. If we compare that to the stochastic oscillator up top, it's inverted. 80 is at the high. In other words, you're 80% away from the low. If you're at 20 down here on the bottom, it means that you are 20% above the low. So you just have to kind of get your bearing straight. But now let's take a look at the two lines. They are exactly the same. And the reason should be simple. Once again, if the glass is 70% full, it's the same thing as saying it's 30% empty. Just two different ways of expressing the same idea. So how do we read Williams %R? We do it exactly the same as we did with stochastics. This upper band is -20, and anytime we are above that, such as here, for this particular one they actually shaded in gray, give you a nice visual to see that you are above that high, it just means that you are in the overbought territory. It might foreshadow that we might be coming into a downturn, but it could also show extreme strength. So a big mistake that a lot of new traders make is they say, oh, the line just crossed from below the -20 mark to above it, and therefore we need to start going short. And that's not necessarily true. Highs can go much higher. It can actually be a sign of tremendous strength. Our signal for Williams %R is exactly the same as it is for stochastics. So let's take a look right here, for instance. So you can see that when the line crossed from the high side down, that's actually going to be the point that you're going to say is showing weakness. That's the point that you really want to make sure that you are hedging, rolling, and morphing your positions. Notice that it exactly corresponds to that same point with stochastics. And if we check, let's see what it actually did through here. We actually did get a little bit of a downturn in the stock. Not a major one, but certainly was showing signs of weakness. Let's go ahead and pull these back up. On the flip side, if Williams %R is on the bottom, anything below -80, it just simply shows that you are oversold. So it doesn't necessarily mean it's going to turn bullish. Instead, the signal for expecting the bullish move is when the line crosses from below -80 to above, such as right here. That would show that we are coming into an expected bullish trend. And it should be no surprise that it exactly lines up with the stochastic oscillator. So once again, this is why I think it's meaningless to put stochastics and Williams %R on your charts and trying to use that as a confirming signal. It will always confirm. So it's just redundant. So what do? Pick one. But there's no sense in using both. Now, one final note, because these are inverses of each other, if we are, let's say, 70% off the high, that's the same thing as saying that we are 30% off the low. And so these numbers, for getting the minus sign, will add up to 100 because the formulas are simply inverses of each other. So let's take a look over here. You can see that Williams %R is -66.50. That simply means that the current price right now is 66% below the high from this 14-day period. So we are definitely more into oversold territory. Now, of course, we did just cross from the low side up, so that's actually a bullish signal right there. But if you think about it, the number is now -65 from the high. Isn't that the same thing as saying that we're 35% off the low? And you can't quite see it here because this red box right here, this bubble, is the moving average, showing at about 30. But this black bubble right here, let's see if we can get the crosshairs. And I'll line up right there on that black mark right there. And you can see that it's just about 35. So again, if you're 65% off the high with Williams %R, it's the same thing as saying that you are 35% above the low. Now, one final thing that traders sometimes use with Williams %R is to look for divergences or maybe signs of weakness. So you might see, for example, that Apple was kind of stayed consistently above this -20 level, showing lots of great strength. But let's say that there was a time that maybe this black line peaked up to here, didn't quite get through the -20 line, did it again, didn't quite get through there, even though the stock was still making new highs. You might see that as a foreshadowing of weakness. So there are other interpretations, and we can certainly talk about those in future videos, but right now I just want to make sure that everybody's at least comfortable with the basic technical indicators. So now you've got one more to add to your list, but again, I would pick one between stochastics and Williams percent R because they're just two different ways of expressing the same idea. If you'd like to learn more about the art and science of options trading, please check out the Alpha Trader course at optionsatoz.com. And if you're looking for some helpful tips in getting you started, please join our Facebook trading group, Options A to Z. It's a free site, lots of great commentary and market videos, and we'd love to have you join.